Hey everybody, this is Dr. Tom Carr, aka Dr. Stoxx. Welcome to Trading Boot Camp. Before we get into the webinar itself, I wanted to give you a little background of the Befriend the Trend trading story. That's the company that lies behind drstoxx.com. We began in 2002 with our first daily stock pick letter. It was then called the Swing Trade Letter, now called the Trend Trade Letter. It is by far our most popular letter. It trades up to 10 mid to large cap size stocks that are very volatile and moving quickly. And we launched also our website at that time. We have published the Trend Trade Letter every market day since then, over 11 years of daily stock picks. In 2007, we launched our second and by far our most profitable newsletter, the ETF Reversal Letter, and that was followed about 3 years later with a letter geared specifically at small cap or lower priced stocks, and it only trades 5 to 8 of those positions, so it's perfect for smaller account traders. That's called the Cheap Stocks Letter. During that latter period of time, we also published 2 books with McGraw-Hill, Trend Trading for a Living, which came out in 2007, and Micro Trend Trading for Daily Income, which came out in 2010. I'm happy to say both have become best-selling books and have been translated into a number of different languages. In the latter part of 2013, we'll be coming out with our third newest book, Market Neutral Trading, also published with McGraw-Hill. In 2012, I put together a small fund for a number of my clients called the 818 Fund, which is named after Deuteronomy 8:18, and we incorporated a management company called Kingdom Capital in order to oversee the day-to-day management of that fund, and that's still going strong today. And then in 2013, we launched our new site, drstoxx.com, which contains quite a bit of free website content and daily market updates, stock market analysis, stock trading ideas, as well as webinars, trading manuals, and a new private coaching service. In this webinar, you're going to learn several things. We're going to go over some real basic information about how to buy and sell stocks. Might be review for most of you, but it never hurts to go over the basics. And we're also going to give you a tip on how to cut your commission costs to zero. Secondly, most of you watching this webinar are new subscribers of ours, so I'm going to introduce you to our 3 premium stock pick letters and tell you how each one works and how you can best trade them. Thirdly, I'm going to go over a number of key resources that I consider essential to your trading. Fourthly, we will help you determine how to determine general market direction, and this will help you to know whether you should be primarily long or primarily short the market. And lastly, we will help you build and scan a watch list of the best stocks for trading. Before we begin with any of that, though, let me first read a disclaimer. Everything taught in the Trading Bootcamp webinar, including all strategies, systems, methods, and techniques, is for educational purposes only. No promise or guarantee of any kind is being made. Those watching this seminar assume all risks associated with any activities related to the educational material herein. They understand that active trading can result in the loss of trading capital, that only risk capital should be used for active trading, that active trading may not be suitable for everyone, that simulated performance can be better or worse than real money trading, and that active trading can in some people result in behavior that is detrimental to one's financial, physical, emotional, and relational health. With that out of the way, let's move on to our first topic, how to buy and sell stocks and cut your commissions to zero. First, I always recommend before anyone begins trading stocks that you consider opening an account, if you don't already have one, with a deep discount online broker. There are 2 brokers that I can very strongly recommend. The first is Interactive Brokers, I would recommend this service if and only if you have an account size of $10,000 or more. That's the minimum in Interactive Brokers to open a margin account, which you will need in order to short Stoxx. If you don't have 10,000 to trade with, and I myself started, as some of you probably know through my books, I started with $2,000, so I know what it's like to be limited by that amount. If you have something less than $10,000, I would recommend then using MB Trading. You can open an account in MB Trading with as little as $1,000, maybe less, but it takes $2,000 to open a margin account. So I would recommend using that if that's about the amount that you have to trade with. Both are excellent companies. Both have very usable trading platforms, and if you're stuck with how to use them, then their customer service in both cases are really quite good. Interactive Brokers, which I've always used and still use today, was not known for its customer service for many years, but they have really turned that around. Their customer service now is second to none. Secondly, the buying and selling of shares is a little bit like an auction. If you're familiar with an auction process, or even if you buy anything on eBay, you know that there are always buyers and sellers of the item being sold. In this case, what's being sold are shares in a company. And the buyers step into the market and place what is called a bid price. The bid price is the highest price that that buyer is willing to pay for those shares in the market. Sellers step into the same market and set what is called an ask price. The ask price is the lowest price that they're willing to offer for the shares that they have for sale. Now, when the bid and the ask meet together in the middle, then a trade is executed. Otherwise, if they are separate, that spread between the two is called the spread. And it can be as little as a penny, or it can be as much as 40 or 50 cents, depending on or even more, depending on the size of the share price and the liquidity of the stock being traded. And as I just said, when bid and ask meet in the middle, the trade is executed. When you're setting a bid price in order to buy shares, or setting an ask price in order to sell your shares, there are two types of orders that you can use. There is the market order, which means that you must buy, when you set a market order to buy shares, you must buy at the current ask. Or if you're selling shares, then you have to sell at the current bid. Even if you don't like that bid price, when you set a market order, you're telling the market, I'm willing to buy those shares at the current ask, or I'm willing to sell my shares that I already own at the current bid. If you don't like that the price that's being offered, then you can set a limit order at the price that you think the shares are worth, or the lowest price you're willing to buy them at, or the highest price you're willing to sell them at. So a limit order is a specific price order. So you will set a specific price down to the last penny, and that's the price that you will be either buying shares at or selling shares at, no matter what. So if you are trying to buy shares at a specific price and the current ask price is above your limit price, your trade will not be executed until someone is willing to sell shares at your limit price. Conversely, if you own shares you're trying to sell to the market and you set a limit price to sell them above the current bid, your shares will not be sold until the bid rises up to meet your limit price. Let me show you an example from my own trading platform here of what it looks like when you're setting orders. We have here 4 stocks. You can see the symbols off to the left here: SVM, AG, USEG, and Q Core. And in the middle here, these numbers represent the current bid prices on the left, the prices that people are willing, the lowest price people are willing to buy those shares at, and the ask price here on the right. The highest price that people are willing to sell the shares at. So you can see that the spread between the bid and the ask for SVM is only a penny. There are buyers on the bid at $3.03 per share, and there are sellers on the ask at $3.04 per share. And whenever one of those buyers at the bid is willing to pay $3.04, a trade is executed. And whenever any one of the sellers is willing to sell at $3.03, a trade is executed. You could also see size numbers to the left of the bid and to the right of the ask. And this is important information. Don't need to worry too much about it just now in a basic webinar like this. But it will tell you whether there are, generally speaking, more sellers or buyers in a particular market at a particular time. We won't worry about that here, however. Just take a look at the spreads here. In AG, we can see a 2-cent spread. There's only a penny spread in USEG. It's a lower price stock, and that usually means smaller spreads. And then Q Core, which is a little higher price stock, we see a spread of about 9 cents. So that's pretty typical. All 4 of these stocks are fairly liquid stocks, fairly well-traded stocks, but you can see the difference in the spread. Now here's a little tip. I myself personally like to use limit orders for most of my orders unless I'm desperate to get into a stock or out of a stock, in which case I'll use a market order. But if I use a limit order and I put it between the bid and the ask, then I'm going to shave a few pennies off of my buying price, or I will add a few pennies to my selling price, and that is going to compensate for the commission that I need to pay to get in and out of those shares. I pay a commission of ½ cent per share or less, but if I can shave a penny off of that trade by putting a limit price between the bid and the ask, or in the middle of the spread, then I will in fact add ½ penny per share to my cost, to my total profit, or deduct ½ penny per share from my cost basis for that position. So that's how you can eliminate commissions. Now, a limit order placed between the spread, if you have a little patience, you can let it sit there, and sometimes it'll sit there for 10 minutes and sometimes it'll sit there for a few hours. Depends on the market and the general market conditions and all of that. But I personally like to do that. 9 times out of 10 you will get a fill, especially in a fairly liquid stock that is seeing a lot of buying and selling action. So consider that as a way to eliminate your commission costs, to add a little bit of profit to your overall profit potential, and it's also a way of controlling the price that you get in and out of your positions as well. You're not necessarily at the mercy of the market that way. I want now to go over a number of other order types. We've learned about market orders and limit orders. There are a number of other kinds of orders that you can use, or conditionals that you can add to orders that you use. For example, the MOC, or market on close order, is, as the name implies, a market order. You can't use this with a limit order, but it's a market order that will execute exactly at the closing price of the day on which it is set. So whatever the closing price is, you will get exactly that price for every share that you're either selling or buying. I particularly like to use this order if I feel that the close is going to be the best price of the day. I also like to use this order to enter new positions if I think the market is going to gap up the next day for longs or to gap down for shorts. You're guaranteed to get every share that you want, or sell every share that you have, at the closing price. So that's the MOC, market on close order. It's a conditional that you will add to your market order to sell the shares you have or to buy the shares that you want. Another conditional you can use is the OPG order. It does say market on open order. I don't know what OPG stands for, frankly. I tried to look it up, couldn't find it. But in fact, you can set a limit order at using the OPG conditional. The OPG conditional means that your order will execute right at the open price or better. So if you set a market order with the OPG conditional, you will buy shares right at the official opening price, the very first price that a trade is executed at for the security that you want to buy, the stock you want to buy, or you will sell your shares right at the opening price if you set that as a market order. If you set it as a limit order, then you will get your limit price or better. But if you set it as a limit order and the price is, if you're trying to buy shares, the price is above your limit order, you will not be executed. The trade will cancel automatically right after the open. So you will only get executed on a limit order if the opening price is at your limit price or better. There are also several types of stop loss orders that you can use when you're trading. There is the stop market order, which is a stop price you would put on an open position. If, for example, if you're long a particular stock and you think it might fall below a level of support, you're worried that it might do that and then continue to fall through that support, you would put your stop order at a specified price just below that level of support, and if you set it as a market order, then your order will automatically execute as soon as that price is reached. You may not get that specific price because sometimes a sharply falling market will fall through your limit price, and because you set a market order, you are locked in to selling all of your shares at whatever the current bid is. If that bid keeps dropping, then your order could execute below your stop price. But you're guaranteed an execution. You can also set a stop limit order. Sorry, two things came up there at the same time, but we'll go cover both of them. You can set a stop limit order, which means your order will execute only at your limit price should the shares of your stock trade to your limit price. But that also means in a sharply falling stock, you may not get out of all of your shares. You may end up hanging on to some shares at a loss because the price moved so quickly through you couldn't get them all executed. So a stop limit order is a bit of a risk if you're using it as a stop loss. Stop market order guarantees that you'll be out of your shares altogether. A trailing stop is a stop loss that is used. It can be either a trailing stop market or a trailing stop limit order. And this is an order that will dynamically change the price that you set it at if the shares that you own move favorably. So if you have bought a stock and you're long, say stock ABC, and ABC moves up $1 while you're in that position, your stop loss will also move up $1 automatically. Once it moves up, it cannot move back down. So your trailing stop loss, in effect, reduces your risk as the trade moves favorably, and it can also protect profit once your stop loss is above your entry price. So that's the trailing stop, and you can again set that as either a market order to execute automatically regardless of the price. As long as it has touched your stop price, it will begin executing your shares, or a limit stop, in which case you will only execute your shares, you only get out of your shares at the limit price you specified, and you may not get out of all of your shares in that case. I want to show you a screen from my own trading platform to let you see how all this works in a real-life trading situation. Now, this is a screenshot of my trading platform after the market close. So you're going to see some unusually large spreads between the bid and the ask. You wouldn't normally see that during market hours. But let me just point out some of the features here of this. This is my portfolio screen, and I have a number of other screens I'll show you in a moment. And as I said before, I'm using interactive brokers, so this is what you would be looking at if you're using interactive brokers. Over here in number 1 in the upper left-hand corner, you will see the profit on the day, on the day's trading. That was a pretty good day, about a 1% gain, which is fairly typical of a good day. And of course, when it's a bad day, it would be, the reverse. It would be in the red, down about that much. Fortunately, we have more good days than bad days, and that's how trading works. Under number 2, you're going to see on the left side of that circle numbers that are green at the top and red down at the bottom. Those are amounts of money that has either been gained or lost on that particular day's trading. And then in the right-hand column, you'll see green and red values. The green is profit in the position since it opened, including the day's trading, and losses on the position since it opened. So you'll see that there. That's called unrealized profit or loss. After the symbol itself, you will see how many shares are owned of each symbol. That's located here under position. And then over here under 4, you'll see the bid and the ask. And again, the spread here is a little bit wide because this is after market hours. These positions here that are grayed out in the portfolio window are option positions. So you'll see I have on 4 option positions at this time. Here's another part of the window here. Up at the top, I use very frequently a rebalance function that allows me to balance the positions that I have by percentage of total capital. So I normally, when I open a position, normally put on about a 5% of total capital position size. And of course, once you're in a trade for several days or weeks, that position size will change. If it goes up and you're long, you will see the percentage of your total capital grow. And if it's going down and you're long, you will see the percentage of total capital begin to shrink. So when it gets over 5%, say around 7%, 7.5% of my total capital in any one position, I will likely begin to take some of that profit off the table to move it back to 5%. And if it has, say, shrunk down to maybe 3.5%, 4% or so, and I still like the stock quite a bit, I still feel good about its prospects, nothing has happened fundamentally to the company, there's nothing on the technical chart that tells me that anything unforeseen is happening there, then I am likely to add some money to that position to bring it up to 5%. So I use this on a very regular basis to keep my position size in balance. I will occasionally go over balance because I might have a hedge position on. I can hedge a third or a fourth or a fifth of my total account by simply putting on a very large size ETF, inverse ETF, a leveraged inverse ETF, and I'll do that quite frequently. And in this case, I have a naked put position here at the top. It's showing 25% of my current account value is dedicated to that one position. Now I only have 2 options position, and market value of that position is only about $2,000, but because the underlying stock is quite a high-priced stock, and I'm obligated to buy those shares if the options expire in the money, then it's showing here a very high percentage of my portfolio. But we don't need to worry about that here. I also want to point out this little screen here off to the right is where you will see all your open orders that haven't been executed and all your closed orders that have been executed. And then this little window over here is where all the magic happens. This is the window where you will put on trades and take off trades. You will buy and sell your shares in this window. So let's take a little closer look at that window to see what is going on there. So over here you have number 1, you have a sell button. If I already own the shares and I hit that button, then I'm going to sell the shares that I own. If I don't own the shares yet and I hit that button, I will be selling short the shares. I'll be initiating a short position in that company. Number two is where I set the order type for the trade I'm about to put on, and I have four options there. I can set a limit order, a market order, a stop order of various kinds, or a market on close order, as we talked about before. Number three is used to set the number of shares that I want to buy, and I normally use the rebalance window to set this automatically, so it will do all the calculating for me. But if I'm selling a position that I already have, I open this drop-down menu here, and it will give me the exact number of shares I currently have, and I just toggle that. I highlight that, so it will automatically set my order to sell all the shares that I have. Number four is where I'm setting the limit price. If I'm using a limit order, then I will put the limit price in there. One of the nice features of this is that it will automatically give you both the bid price, the current ask price, and then a median split between the two, assuming that it's more than a penny per share. And so, excuse me, so this is very handy if you want to, as I said before, try to reduce your commission costs. I very often put a limit order at that median price as suggested in that drop-down menu. Number five is where you will be setting the time conditional on your trade. In most trades, you will simply leave that at the default day position because you want your trade to execute that particular day. But if you are putting on a trade, say a stop loss trade or a target exit trade that you anticipate will not execute that day but may execute sometime in the future, you can set GTC as the conditional. That's good until canceled. And that will normally give you 2 to 3 months, maybe more, of time for that order to execute. And so it will remain with your broker, and you'll see it every day in the open order window box until you actually go in and manually cancel it yourself or the trade is executed. And that's kind of handy. If you're putting on a stop loss, you don't want to have to reset it every single day. So you set the GTC conditional, and then you're good to go. And if you're going to execute your trade right at the open, you can set the OPG conditional, and that will execute right at the open. And then over here on the far right is our buy button. I will use this to buy shares if I'm initiating a new long position. And I also use this button to close an open short position if I need to buy back the shares that I've borrowed to sell. Now let's move on to our second topic, which is how to use our premium stock pick letters. So I first want to talk to you about our trend trade letter, which, as I mentioned before, was the first letter that we published. It was launched back in October of 2002. We've been publishing it every market day since then. It's been profitable every year, nearly every quarter, most months of each year. It has a total return on investment of over 2,000% that annualizes to about 31% per year, and that's on over 2,500 closed trades. The parameters of the letter run as follows. This follows a technical setup primarily. The 10 trading systems that I have in my first book, the Trend Trading for a Living book, are the primary setups that we use, but I do have a few new ones that I've developed since then. We also give a strong eye at, we give a strong look at fundamental analysis on each stock pick before it gets recommended to our subscribers. I'm very keen on using fundamental analysis to weed out the best technical setups among the several that usually come through my scans each night. And in this particular letter, we are focusing quite heavily on growth metrics. We want to see strong growth in sales and in EPS per share, earnings per share. We also give a nod as well to valuation metrics. And then we also look ahead at possible future catalysts for the stock, potential buyouts, FDA approvals, earnings coming up on the horizon, that sort of thing. We want to get into a stock that has a good story, a good narrative behind it that will support the technical breakout that we're trading. We take a maximum of 10 open positions in this letter, so you'll get one or two trades most trading days, but once we are up to 10 open positions, then we will no longer recommend any new trades until those positions, some of those positions close. And we trade stocks that are average in price above $10 per share and in volume, daily trading volume of over 200,000 shares per day. So we're looking for stocks that are fairly liquid. Our average holding time is about 1 to 3 weeks. And we have two typical forms of entry into each new position. I will either tell you to buy the stock at a particular price or lower. So you would simply set a limit order at the market open, or you can set it overnight. You can set it early in the morning if you have to go off to work, and you will be executed if the stock trades at that price or better. And sometimes I will occasionally say I want you to buy the stock at a very specific price, which is usually above the close of the previous day. We want to make sure the stock is moving in the right direction. And then you would set a stop limit order or perhaps a stop market order at that particular price. Here's an example of what the trend trade letter looks like. We see a new stock pick suggested here. This is RGEN, and we trade both long and short in this newsletter, and this one happens to be a new long position. This is a stop entry at 770. So if the stock trades up to 770, then our trade will be executed. If it doesn't trade at that price during the trading day, we will take no position in the stock, at least on that day. We may call it again the next day. Here's the suggested stop loss price. So if the stock trades down to that price, we will automatically count this as a closed trade, and we will adjust the stop price as the trade moves in our favor. And then we have the target price, and once the trade hits $10 per share, we will exit at that price and move on, put our money into something that will be more likely to move strongly. Usually the target price is set at a position of resistance, and we don't expect the stock to trade much higher than that. You'll have some commentary of what I'm looking at for the trade and why I like the trade, and then you'll get a technical chart as well. Down here you have the stock picks that are open. You have the symbol, the type, the date of entry, the entry price, the current stop price, which as I said can be adjusted, the target price, and then any action that needs to be taken that day. Our second letter is the Cheap Stoxx letter, which was launched in July of 2010. It has a total return on investment to date of it's actually now close to 300%, and that averages out to about 54% return per year. And that's on over 200 closed trades. This also uses technical setups from my first book and a great deal of fundamental analysis. Now here we're trading lower priced stocks, and some stocks in fact that are trading below their book value. And we're giving priority here to value metrics. We want stocks that are trading under the valuation of the company and are positioned well to improve on that basis. And then we also give a good look at potential future catalysts for the stock. We want to make sure that there's a good story, a good narrative behind the stock, some anticipation of things in the future that give investors reason for hope. We will take a maximum of 8 open positions in this particular letter, and all of our stocks are priced under $10 per share. We don't trade any penny stocks in this, so they're normally priced between $1 and $10 per share. And the average volume is over 100,000 shares per day. The average holding time here is a little bit longer. 1 to 3 months is about average. And again, there are the two types of entry as you saw with the trend trade letter. Here's an example of the Cheap Stoxx letter, and you have the same setup that we saw in the trend trade letter, only we have fewer open positions, and you will see that the price per share of each of these positions is quite a bit lower than in the previous letter. The ETF reversal letter was launched in January of 2007. It is by far our most profitable letter. It has a total return on investment of over 5,000% on 1,500 closed trades. That's an annual return of about 67% per year. Now, this is a very different kind of system. It's a reversal system, which means that we are long or short these individual ETFs. And I'm using a combination of volume analysis, trend analysis, and a mean reversion system that I use and teach in some of my seminars. The popular ETFs that we trade in this letter are SPY for the S&P 500, QQQ for the NASDAQ 100, XLF, which is the financial index, GDX, the gold mining index, IYR, the real estate index, and OIH, the oil services index. Each of these, by the way, has both inverse ETFs and leveraged ETFs. So if you want to increase your risk-reward ratio, you can do that. You don't need to short these ETFs. This is a letter that can be traded in your IRA because instead of shorting, you simply buy the inverse ETF to match the short position of the underlying ETF. In this letter, we are 100% invested 100% of the time in each of these 6 ETFs, but we're either long or short. And any new signal will be a signal to change from long to short or short to long. We offer 2 time frames for this, and you'll get both of these in the same letter. You will see a short-term portfolio of the 6 ETFs, which trades off of signals on the daily chart, and a long-term portfolio which trades off of signals on the weekly chart. The short-term portfolio has an average holding time of about 2 weeks, and the long-term portfolio has an average holding time of about 10 weeks. Entry and exit is always done at the open, so you can use an OPG conditional on all of your orders, and it's very easily done. You'll get the signals the night before the market, and you can place them with your broker either that night or the next morning before the open, and you do not need to be sitting at your computer. In fact, for all 3 of our newsletters, you don't need to sit at your computer. You don't need to wait for a text message or SMS message from me. You simply read them online at your leisure and put on orders the next morning. Here's what the ETF reversal letter looks like. You will see the short-term portfolio here at the top, the long-term portfolio at the bottom. You will see whether we are long or short each of the 6 ETFs. You'll see the date of entry, the price of entry, which is always the opening price on that day, and then any new signals are listed here. So a signal to reverse means we will cover the short in SPY and we will go long. And the same is true for QQQ and XLF, whereas the other 3 ETFs, we will simply be holding them. And then down here in the long-term portfolio, there are no new signals for that trading day. Let's move on to our next section, which is key resources that are essential to your trading. And I have a number of resources that I use as I put together these daily newsletters and manage my own portfolio as well as the 818 fund, among which are a tool that was developed by Stoxx using systems that I developed and explained in the Trend Trading for a Living book as well as the Micro Trend Trading for a Living book. Stoxx is one of the most popular charting, backtesting, and scanning tools that active technically based traders use. And Stoxx approached me a few years ago with the view of developing my systems into a package deal that could be added on to the Stoxx software. And when you have that installed in your software, you simply click a mouse and the software will find stocks from the market that match the parameters of all of my various systems. You will find, I think, 13 different system scans in this toolkit. It's called the Dr. Stoxx Trend Trading Toolkit. And you will also find 11 expert advisories with commentary and position management advice. An expert advisory is a tool that you apply to any chart that you're trading, and it will tell you exactly where the setups are the long signals and the short signals are per my systems. And it will also tell you the best entry price, where to put your stop loss, and where to exit the position. And then you'll also get 6 chart templates. These are configured charts that you will apply to various systems, so you don't need to put on any of the indicators that are already on the chart for you. So that's something that you can purchase, and if you want to get a discount, use this link right here, metastock.com/befriend the trend. You'll get a nice discount. You'll also get a free month use of the software as well as the add-on. You can give it a try. It's free. It's a free trial, and if you cancel at any time, there's no charge. Stockcharts.com is one that I recommend in all of my books, and it's very reasonably priced at about $50 a month. You're going to get real-time charting, and you'll get a very strong and sound scanning system that you can use. It's very user-friendly. You can build your own scans, or you can build them along the lines of some of my systems very easily. Do that in stockcharts.com. The disadvantage to StockCharts is that it does not have a backtesting feature, as does Metastock, and its real-time charting leaves quite a bit to be desired. It doesn't update regularly. It's a bit sluggish. But with that said, it's easier to use, and it is a bit cheaper. Metastock's price, by the way, is about $60 a month, so it's really quite reasonable in comparison, especially since you're getting a backtesting feature that you can use to tweak the systems that are in there or build your own systems. Now, to build your own portfolio of stocks that you will be watching each day to search for setups, as well as stocks you might be interested in trading, and tools that you will use to do both technical and fundamental analysis, I can recommend 3. finviz.com is an excellent tool. It's fairly new on the market, but it's really an up-and-coming tool. You can purchase a subscription to it if you want a few more bells and whistles, but I use the free version, and it will give you just about everything you need to determine where a stock is in terms of its fundamentals, both its growth and its valuation metrics. You'll also get some nifty tools like who's buying on the inside, who are the insiders that are buying and selling. You'll get institutional support for various stocks. You'll get analysts' expectations of where the stock should be going, and those sorts of things that you don't find in every free fundamental service. Investors.com is the online version of the Investors Business Daily newspaper that I don't think is even printed anymore. This is William O'Neill's brainchild. He's the author of Make Money in Stocks, one of the all-time great trading books, best-selling trading books. And Investors.com, for a reasonable price, I pay the $14 per month fee, and I get access to a lot of their database, which gives me really strong fundamental analysis as well as relative strength and trend analysis, and I just find it an invaluable tool. You'll get a numerical output on every stock that is trading, and I use that as a way to weed out the best stocks from the rest. I want to buy stocks long that have numbers that are above 80, and I'm 80 on a scale of 1 to 100. And I want to sell stocks short that have numbers below 50. It's just kind of a general rule of mine. And then Vector Grader is a free site, but for $12 a month you can have full access to all of their fundamental data, which is really worth it. And Vector Grader gives you also a numerical read on your stocks, but it has a stronger emphasis on valuation, whereas Investors.com puts more emphasis on growth. So between the two numbers of Investors.com and Vector Grader, you'll get a pretty good sense of whether your stock is a growth stock or a value stock. And the best stocks, of course, to buy are those that have strong numbers in both areas. So I like to use both of those tools as ways of strengthening my confidence in the position that I'm about to take. There are a lot of educational resources out there, and this is a rather shameless plug for our own site, but I'm going to suggest that you consider drstoxx.com as a kind of one-stop shop for your trading webinars, your trading manuals, your systems development, and so on. At drstoxx.com, although presently we're in the process of uploading a lot of this content, but eventually we will have 4 skill track webinars on offer, 3 systems track webinars, 3 complete course webinars, 5 brand new trading manuals, and a private coaching service for those that really want to take the ultimate step in strengthening their trading skills. So the webinars are being developed as we speak, but they will be uploaded into the site, and I'll let everybody know through email that they're ready to go. And in these webinars, you're going to find everything you need to know to strengthen your trading skills, to master trading systems, and you'll also find complete courses on things like day trading and options trading. Now, moving on to our next topic, we want to learn here a system for getting a good sense of the general market direction. And you want to know whether the market is in an uptrending mode or downtrending mode or something in between, because in an uptrending mode you'll want to be primarily long, if not 100% long, and in a downtrending mode, of course, you want to be primarily short. So it will determine your position mix as well as your position sizing. So learning how to read the general market is a very handy trading tool. Now, in my webinars, in my Trend Trading for a Living book, I teach a rather simple system there that I'm going to be introducing to you here. In my webinars, I teach another system that uses the MACD indicator as applied to the weekly chart. So I'm going to call that the easy way to determine general market direction. It tends to be a little more sophisticated than the second way, which I'm going to teach you here, which is the easier way, which is simply using moving averages on a weekly chart. So let's look at that second option there, the easier way to determine general market direction. And we'll do that by looking at 2 moving averages that we will overlay on the weekly price chart of the S&P 500. Our setup is very simple. We're going to apply the 20-period simple moving average and the 50-period simple moving average to the weekly chart of the S&P. If you are more of a short-term trader, you can consider using the 5 and 13 simple moving averages. If you have a longer term frame of trading, then the 40 and the 100 will work as well. And all 3 of these sets work just fine to determine market direction, but of course it depends, which set you'll use depends on the general time frame of your trading reference. So the rules are very simple. About every close on a Friday afternoon or sometime over the weekend, you're going to take a look at that weekly chart to determine the market direction for the next week's trading. And very simply, if the 20 simple moving average is above the 50, we consider ourselves to be in a bullish market, and our focus will be on long setups for the next week. And if the 20 is below the 50 moving average, then the market is more bearish, and our focus for the next week will be on short setups. I like to nuance this system a little bit by throwing in a few options. For example, if the 20 is above the 50 moving average, but the price of the S&P is trading between those 2 moving averages, I consider that to be a weak bull market. And in that case, I may want over the next week to begin to reduce my long exposure by taking some profits, selling off some of the positions that I already have, and maybe not putting on as many new positions as I might otherwise. If the 20 is above the 50, but the price of the S&P is below the 50 moving average, I consider that to be a potential bear market. That may be a rollover from a bull market to a bear market. I certainly don't want to put on any new longs at that point. The next week, in fact, I may look at reducing some of my risk by either closing positions, putting on perhaps some covered calls or selling calls against my open long positions, and looking also at putting on some actual short positions in various stocks. You can also use some of the inverse ETF exchange traded funds, either the non-leveraged or leveraged sorts, to reduce your risk a bit and to give you some exposure to the short side of the market. Conversely, if the 20 is below the 50, but the price of the S&P is between the two moving averages, that's a weak bear market, and at that point the next week you would want to think about reducing your short exposure. And if the 20 is below the 50 but the price is now trading above the 50, then that's a potential reversal to a bullish market. And again, you would want to not put on any new short positions and instead begin to hedge your open shorts by adding some long positions in stocks or some of the leveraged ETFs. Let's take a look at the S&P 500 chart with those two moving averages overlaid. I have highlighted here bearish and bullish periods, bearish of course in red, bullish in green, and this is based simply on the crossovers of the two moving averages. I've also highlighted in the black circles there those periods where you would begin to consider lightening your exposure to one side of the market or the other, and perhaps putting on some hedge positions in order to reduce your risk and expose you to profit on the other side of the market. So that's represented by the choppy price action there. Consider that each bar on this chart is a week of trading. So the area of trading within those black circles represents several weeks, in fact several months of trading. So for several months you may be in a position where you're holding a mixed bag of stocks, long and short. And that's normal. That's just part of trading. That's how you should set up your portfolio. Only when the market is clearly in a strong bull run should you be completely long, or in a strong bear run should you be completely short. So let's move on to our next topic, which is how to build a watch list of the best trading stocks. Your goal here is to compile a list of stocks from among the 8,000 or so stocks that are trading, of 40 to 60 stocks, roughly about 50 or so, that have three things in common. All stocks that are great trading stocks have these three things in common. They are trading on above average daily trading volume. Now your average stock among the 8,000 stocks trading trades at 93,000 shares per day. So anything over 100,000 or so shares per day is sufficient to put yourself into a fairly liquid stock. And I myself like to look at stocks that are trading over 500,000 shares a day. But if I do find an excellent trading setup in a stock that's only trading, say, 150,000, I will consider that as well. You want to look for stocks that are trading at above average volatility. Now 1.0 beta is the marker for volatility on stocks, and 1.0 beta means that the stock is trading in line on a volatility basis with the S&P 500. So if the S&P 500 goes up 1%, your stock is likely to go up 1%. A beta 2 stock, 2.0, is a stock that will go up 2% for every 1% that the S&P rises, and conversely on the downside. And we like stocks really that are trading at 2 beta or above. 3, 4, even 5 beta stocks are often very strong trading stocks. Now again, this is not a hard and fast rule. I will, in our newsletters, put on stocks that trade at even below 1.0 beta. Beta is a short-term indicator, and sometimes a stock that is showing very low beta over a short term will suddenly spring into action because it's in a price consolidation that has reduced its beta, its volatility, and that often precedes very strong price movement. So there are exceptions to this rule, but in general, we want to look for stocks that are commonly trading at beta values of 2 or higher. And we want to trade stocks for the most part within the pricing sweet spot. Stocks trading under $10 per share can be extremely profitable. Those are the stocks that we trade in our cheap stocks letter. But the risks involved in those stocks are much higher. You can win some very large gains on stocks like that, but you can also lose some very large amounts of money. Whereas stocks trading over $50 a share tend to have lower risk profiles, but the rewards are also less. A stock like Google trading up around $900 a share, or Apple around $500 a share. These are great stocks, great companies, good long-term buy and hold sorts of positions, but on a short-term trading basis, you're looking at, gains of 4 or 5%. That's not bad, but we really want to look at stocks that are likely to gain 10, 15, 20% over the next week or two. And stocks trading between $10 and $50 tend to fit that bill better than stocks trading much higher. So again, studies have determined that on a risk to reward basis, the $10 to $50 price range is your sweet spot for trading. There are various tools that you can use to scan the markets for these kinds of stocks. If you have the Dr. Stoxx Trend Trading Toolkit with Metastock, then you have at your disposal already a pre-configured scan for this very thing. With a couple clicks of the mouse, you will have an excellent watch list of 50 to 60 stocks, all of which are trading above average volume, strong beta stocks, and in the price sweet spot. And of course, you can always dig down into that scan and tweak those numbers a bit if you want to look at lower price stocks. That's fine too. Stockcharts.com has a great scanning tool as well, and it's very easy to configure. And you are able, with the exception of beta, you are able to scan for stocks that match 2 of the 3 criteria. But there are some ways of highlighting volatile stocks without using beta. I'll leave it up to you how you do that, but I've managed to configure a volatile trading stock scan for stock charts that I use myself occasionally, and I don't have beta in there. Stock charts does not carry beta as a parameter, but you can. There are workarounds on that. FinViz, however, does carry beta, and you can scan for stocks trading above average volume, high beta. The only problem with FinViz is that you cannot set 2 limits on the price. So you either have to scan for stocks trading above $10 per share or stocks trading under $50 a share, and then you'll just have to manually weed out the stocks that are either priced too low or too high. So your best bet there, again, is the Trend Trading Toolkit, the Metastock add-on, which, again, is only about $10 a month more than the stock charts, and will give you everything you need without having to configure a scan yourself. So our steps are these. You're going to run the scan that either you've created or the scan in the Metastock Toolkit. You're going to save the results of that scan to a watch list. If you come up with more than 50 stocks, and often you will, especially during volatile market periods, then you want to sort the stocks based on beta. So take the top 50 high beta stocks that are also trading between $10 and $50 a share and on above average volume, and put those stocks into a watch list. Then you're going to be creating a chart template that you will apply to every stock in that watch list. Again, if you're using Trend Trading Toolkit, you won't need to do this because we've already configured a chart template for you. You simply right-click on the watch list and apply that template to every stock that's in the watch list. It's very easily done. A simple click of the mouse will do it. But if you're using stock charts, or FinViz actually doesn't allow you to create charts, but stock charts does, or some other charting system, then you would need to put the following indicators on the chart. This is my preference. You can tweak this or change this however you see fit, but what I normally put on my charts are these. I put on the volume bars with colored-coded volume bars with a 12 simple moving average overlay. That tells me whether the volume is above or below average, generally speaking, going back over the past 12 days. I also put on the 20, 50, and 200 period moving averages, simple moving averages, along with Bollinger Bands. So once you have Bollinger Bands on there, you don't need the 20 period moving average because Bollinger Bands includes that already. And then I also include MACD, moving average convergence divergence, which is a lagging momentum indicator. Stochastics set at the trader's 5 periodicity with a 3 period smoothing, percentage D smoothing. And that would be a slow stochastics if you have a choice between slow or fast. Stochastics is a momentum indicator, but it also gives you a good indication of overbought and oversold levels. The CCI indicator, Commodity Channel Index, is a momentum indicator, and it's quite responsive to the market. I use the default 20 period setting for that. And then on balance volume is one that I use quite a bit, and it is a running average of your volume balance. So every share traded during the day on an up day is added to an ongoing cumulative total, and shares traded on a down market day for that particular stock are subtracted from the total. So you'll get trends in your volume balance indicator, and those trends should correlate with price, and if they don't, then you have some tradable information. I should also include here the RSI, or Relative Strength Index, which I use frequently on charts too. That's set at a period of 5. And there are a number of other indicators that I will occasionally put on, the rate of change, ROC, or the width of the Bollinger Band, or sometimes the percentage B indicator of Bollinger Band. There's a number of different nuanced indicators that you can use, but these are the ones that I tend to use most often. Once you have the chart template applied to every stock in your watch list, then you're going to open the watch list, and here's where the hard work comes in. You're going to scan through one by one the charts as they come up, and you're going to be looking for a variety of things. The first thing I want to do when I'm eyeballing my watch list is I want to eliminate charts that are showing a large recent gap in price. Sometimes a stock will gap up 30-40% because it's been bought out by a bigger company. You definitely don't want to keep that in your watch list because those shares are just going to linger at that price level for weeks as the deal plays out. So we can eliminate those. Often stocks that have sharp up or down gaps will be stocks that will trade kind of out of sync with their indicators, so it's best to leave those charts aside. Small gaps we can deal with, but I'm talking about gaps of 10% perhaps or more, depending on the stock. We also want to avoid stocks that are not showing clear trending action or clear price consolidation action in the context of a larger trend. There are charts out there, and you'll see stocks that show very choppy price action. It could be because of low volume. It could be because of indecision on the part of traders. It could be a news cycle that they're caught up in that is causing bulls and bears to go back and forth. Whatever reason for the choppiness, we just want to leave those charts aside. They're not easy to trade, and often you'll get stuck in one of those for several weeks as price goes nowhere. So we want to eliminate those charts too. What we'll be left with is probably 40 to 45 really healthy, solid, tradable stocks that we're going to be looking at each and every day, and we'll continue to update these charts on a regular basis. So I'm going to, of the 45 or 50 stocks, whatever stocks are left, I'm going to highlight several charts of interest. It might be 3 or 4, it might be 10 or 12, just depends on market conditions and so on. And I'm looking for strong trending action, or I'm looking for price consolidation within the context of a larger trend. Those are charts I'm going to highlight. And by highlighting, I mean I draw in trend lines, I draw in support and resistance lines, I mark other points of interest, maybe areas of price support, price consolidation, chart patterns as they appear, triangles, inverted head and shoulders, rounded bottoms, and so on. And I might also mark on the chart notes about upcoming or pending events that might affect stock price, like an earnings announcement coming up or an FDA assessment of certain phase 3 research done on a stock the company's developing, that kind of thing. So I tend to make a lot of notes on my charts because I want to know as much about the company as possible. If the company recently came out with earnings and reported better than expected revenue growth and raised their guidance going forward, I'll mark that on the chart. If an analyst has come out with a very bearish report on the stock that is my chart of interest, I'll note that on the chart as well. So I want to have as many notes on those charts as possible. And if I can, I'll mark the date on which those events took place, or I'll mark down the date of the future event. Now, this is the kind of chart that you want to delete. Titanium Metals was a company that was bought out by a larger metal company at a 43% premium. Shares shot up overnight by that amount, and of course, that's where they will stay until titanium is no longer Titanium Metals. So you don't want to do that. Your money's just going to get stuck in there, and you don't want that to happen. The kind of chart that you're looking for looks something like this. This is one of the best trading stocks over the last couple of years, and it still is a good trading stock. It just hasn't been trending quite as clearly as it had been. But this is Bon-Ton Stores. It's a specialty retail shop. I have no idea what they sell or who their audience is. I've never been inside a store. But they have had an excellent tradable chart over the last couple of years. Now you can see here in 2011, BONT was in a very clear downtrend. So if this stock showed up on my watch list scan, I would certainly hang on to this one, and I would mark this out as a chart of interest because it has a strong trend. And let's dig down a little deeper into the early stages of that downtrend to show you the kind of thing I'm looking for when it comes to actually trading a stock like this. So this is early on at the beginning of that downtrend as the stock is beginning to roll over. It had been 2010 in a fairly decent uptrend, but for whatever reason the stock was out of favor and people were selling it. Traders, investors were selling it. Now, what I like about this downtrend, if we look up here at point A, is the fact that OBV, this is the on-balance volume indicator here at the top, is in a very clear downtrend. The smooth moving average, the 21-period moving average overlay is clearly downtrending. The indicator itself, which is the blue line, is staying below the moving average for a very long time, and that indicates strong distribution of shares. That means that traders are running for the exits. Now, if we go down to the chart itself, we see that at point B, we have a lower high following the uptrend. In fact, this bullish gap up right here looks very bullish, but it turned out to be kind of the last gasp of the bulls. Strong sell-off, lower high, continued sell-off. So once we have a lower high with a rollover and on-balance volume indicator, we're also seeing this is the relative strength indicator here, RSI. We're seeing it's showing quite a bit of weakness as it is making lower highs as well. That's confirmation of the price. Then I'm very interested in shorting this stock. Where am I going to short it? I want to short it on little rallies into resistance. So you want to short downtrends at resistance. You want to buy uptrends at support. And I would add to that, short downtrends in stocks with poor fundamentals at resistance. Buy uptrends in stocks with strong fundamentals at support. So if you can remember that, you've got about 80% of the whole trading game, and that's it right there. So here we have a couple of, actually three rallies into support. In all three cases, price rallied up into the 20-period moving average, which was downsloping at the time, as the 50-period moving average is rolling over. If you were using the Metastock toolkit, I hate to keep harping on that. It sounds like I'm promoting it, which I guess I kind of am, since I helped develop it. But and you certainly can trade well without it, but it's a very convenient tool, and it would have shown you these 3 points here at all three C's. Would have shown sell signals right there at each of those 3 points using the relief rally exploration. And for each of those, you would have seen an exact entry price, where to put your stop loss, and a target exit price for that trade. And all 3 trades, in fact, were profitable, nicely profitable. So we get down to C here, and the stock is really in this downtrend. You can see up here the OBV indicator is clearly trading down. RSI is putting in lower lows and lower highs. Everything's looking pretty negative. And then we have about 4 days in a row, even 5 days in a row, of closes outside the lower Bollinger Band. Now, one of my favorite trading setups is the mean reversion setup, and I have my own version of that particular system. I teach that in a couple of my seminars, and I teach it to private clients, and it is in the Metastock Trend Trading Toolkit as well. A couple clicks of the mouse, and you'll find mean reversion setups on both the long and short side of the market. And here we have one that took place right around Monday the 13th of June. I think this is 2012, but I could be wrong. And we see this little green candle here as an indicator of a reversal of trend, and that would have been a nice buy spot. You can see that it is also confirmed with a higher low in the RSI indicator, and even a nice bullish crossover of the on-balance volume indicator over its moving average. Those 3 signals taken together, the close outside the Bollinger Band with a close inside, and then the 2 indicators showing bullish moves, tell you this is a trend that is in the process of reversing. That's a buy. And it's quite a nice buy too, because you probably would have gotten in here somewhere around between $8 and $8.50, and you can see that it rallied all the way up. It hit the upper Bollinger Band here, nice little price breakout up here, and all of that's taking place at somewhere around 10.50. So from 8 to 10.50 is a nice 30% trade. Now, I'm at the far right edge. I'm interested in this chart again as a potential longer-term bullish chart, because this is a new price high of about 5 weeks of trading, and we're also seeing a nice little price high in the OBV indicator, which is potentially bullish. So let's look at what price did after that. Well, here we have that nice new price high. It turned out that that was in fact the high for about 4 weeks. Price came up twice to that area to more or less meet the high and didn't quite get there, and fell back down about $1 or so to set in some support lows right around the 50-period moving average. The price is just, for about 5 weeks, pretty much going nowhere, going sideways. Now, that can be a sign of bullish consolidation. We have a new uptrend, and the bullish consolidation after the new uptrend can potentially be an excellent place to establish a new long position. So before I do that, however, I want to see confirmation in the indicators. So I look up here at the RSI, and I would want to see RSI either doing the same thing as price, going sideways, or rising. I see neither in this case. I'm seeing, again, lower highs and lower lows. I'm seeing more or less the same thing in the on-balance volume indicator. I'm not seeing any sort of sign there of shares being accumulated by professional money managers. Instead, what I'm seeing is just some very weak trading, lower highs, more or less the same lows being set here, maybe some lower lows, but I'm not seeing anything that looks very bullish. So I'm not going to take any kind of long position within this consolidation, and as we get off to the right edge of it, we start to see some real bearish things happen. We see on balance volume indicator break down through its support line. That's not good. And we see RSI do the same thing. That's not good. And all of that took place right here on this big red candle, which broke down, of course, out of the price box, the price consolidation. Now, if you're inclined to short the stock at this point, because you might think, well, now the downtrend that we had seen previously is continuing after a little period of a breather. And you would have shorted the stock right here at around $8 per share, maybe $8.15 at the close. And that would have been an awesome trade because, as we'll see in a moment on the next slide, that downtrend continued all the way down below 250 to around 230 per share. So from 820 to 230, that is a very nice short. Then we see a very different kind of stock. This is that was 2011. This is now 2012. And we see another little rally and a sideways consolidation over here on the left. And I look up at the on-balance volume indicator for some sort of confirming action. I don't really see that yet. Still kind of looking a little bearish here. So like the last sideways consolidation, I'm not going to buy anything here. It falls, in fact, out of that price consolidation, rises back up again, falls back down. So nothing's looking very bullish there until we hit this point number 2. And here we have a price breakout after a lot of sideways movement. That's one of my favorite, all-time favorite trading setups. I call that the blue sky breakout setup. You'll read about it in my first book, and it also is incorporated into the Metastock Trend Trading Toolkit. You'll find a lot of great examples of the blue sky breakout as well as its inverse setup, the blue sea breakdown. But we want to confirm the price breakout with an OBV high that matches it. And, well, okay, we kind of see a little bit of a peak here over the range highs of the OBV indicator. That's maybe not enough to get me too excited about this, but over the next 2 or 3 days of trading, we see some good bullish action. Price is moving up, making new highs, and on-balance volume indicator now is also moving up, making new highs. I would be inclined to buy the stock right here around the $4 level. That turned out to be a nice entry. We have a bullish run to set a little pivot high here. We have a shallow pullback, and that's what you really want to see in a strong uptrend, or an uptrend that is about to become strong. You want to see nice price thrusting upward with a shallow pullback. Shallow sideways pullback coupled with rising indicator. Look at that rising indicator there. Look at the 21 period moving average rising with the indicator itself. That's awesome, awesome bullish price action. And notice here that we actually have a new high in the on-balance volume indicator before we get a new high in price. If you were just coming onto this stock right here about the 5th of March, you could easily enter right here in this little consolidation bracket. There's 4 days of trading sideways because the volume balance indicator is actually moving higher while price is moving sideways. That's very bullish. That's price share accumulation by some big money traders. They must have known what was coming because as BONT reported some great earnings and other things going on, upgrades to the stock, we got this massive thrust up, followed by some more bullish action, consolidation action, another little thrust upward. If you had gotten in down here at around 5 or even down here at 4 and managed to hold on all the way to 9.5, you're looking at it at a double, which is a beautiful trade within just a few weeks, right? I mean, that's a very short period of time. Now, at point A, let's assume we just came across this chart on the 26th of March, and we see a lot of great uptrend, and everybody's talking about the stock, and analysts are covering it and upgrading it, and all the traders are all excited about it. Should you buy it at this point if you're just coming across this chart for the first time? Probably not. Because while we're seeing price breakout here very nicely, we're not seeing new highs being established in the on-balance volume indicator. It still looks bullish up to this point because the moving average is in an uptrend, but the indicator itself is not setting new highs. In fact, it's setting what we would call a type 2 bearish divergence. That really played itself out once the volume balance indicator crossed over bearishly the moving average right here at point B. Point B corresponds with this red candle right here in the middle of that week of the March 26th, and that would be a pretty decent place to either sell your longs if you're already long, or consider a short position. I myself would probably go very lightly into a short at this point, and I would wait to see some confirmation in the price breakdown. And you would have gotten that right about here where price closes below the 20-period moving average. So I might have a few shares on short at 9.50, and I'd have a few more shares short at 8.50, and that would have been a nice ride all the way down to the 50-period moving average around 6. So those are the kinds of things you're looking for when you're eyeballing your charts. There are always various ways of reading charts, and that's one of the things we cover in our trend trading webinar. I have a full webinar. I'm still working on it. It hasn't been made available yet, but it will teach you everything you need to know about reading charts on a trend trading basis. And so we'll cover all those sorts of setups and more. But that gives you a little bit of a hint as to what you want to look at when you're eyeballing your watch list of great trading stocks. So let's put it all together now in our final slide. And what you want to do as you're looking for trading setups for the next trading day or next trading week is consider updating your watch list if you need to. I update mine on a weekly basis. I would suggest doing it at least monthly, so you have a fresh set of high beta liquid stocks priced between $10 and $50 a share each month at least. And then secondly, you'd want to go to your chart of the S&P 500 to see what it has done over the previous trading session or trading week, and use your moving averages to determine general market direction. Just have a sense, a feel for where you think the market is likely to be headed over the next few trading sessions. Then you would take that watch list and you would run through them one chart after the other. A watch list of 50 charts, once you're experienced at it, will take you about an hour. So it's not like you have to work all night. I myself get up very early in the morning to do some of my chart analysis in addition to some other things I do before the market. And I also work in the evening after the kiddos have gone to bed. So it makes for a long day, but I happen to love what I do, so I don't mind. Annotate charts of interest in the ways that I suggested before. Conduct further research on the 3, 4, 5, or 6 charts that you have highlighted from your watch list. These are charts that you think are ready to go from a technical perspective, but you're going to be doing some further research on them. What I normally do is I dig down into the fundamentals of the company. I want to make sure that I'm buying a lot of growth potential, as well as companies that are not too overvalued, or a company that is very much undervalued but has some potential catalysts on the future that could trigger strong growth potential, or some combination of the two. So that's the kind of further research that you'll want to do to make sure that you are in the best trades possible. I also mentioned using the investors.com site, the finviz.com site, and the vectorgrader.com site as tools you can use to give you a quantitative measure of the fundamentals of your company that you're looking at. And I suggest using those too. Now, if you end up working through your watch list and you just don't see anything that you like, then what you can do at that point is run the scans or the explorations, as they're called, in the Trend Trading Toolkit in Metastock, or the scans that you have built into stockcharts.com or in finviz.com. It also has a scanning tool as well. And if you're a subscriber, as most of you are, to our premium newsletters, you've got already what I consider to be the best stocks trading and best setups and best fundamental support given to you in the new picks each day. So you can pay me to do all the work for you, which I'm very happy to do, or you can do it yourself, and check to see what I'm trading to see if there's any overlap in the two. Or you can see what I'm trading and run it through your own set of analysis to determine what you think are, of my picks, the best picks for your comfort level. Then sometime that morning, you can even do it in the middle of the night. You're going to open up your trading platform. You're going to place any new orders that you need to place. You might need to adjust a few stop losses on some of your open positions because they've moved favorably. There may be a position or two that you need to sell or sell to buy back if you're short. So you would put on those orders then as well. And then once you've done that, I would suggest closing the platform and going off and doing something else. Relax the rest of the day, go off to work, read a book, take care of your kids, whatever you need to do. Trading should not be a full-time profession unless you're in my position where you're not only trading other people's money, but you're also suggesting trades for people that are looking to you and paying you to give you good advice. So in my case, I do a lot more work than one would normally do. But you don't need to do the 6, 7, 8 hours that I do each trading day. So that's it on our Trend Trading Bootcamp webinar. I hope this was helpful for you. If you have any questions, please feel free to email me through the website, drstoxx.com. It will come directly to me. Or you can always catch me in some of the various trading rooms that we are in, or the Facebook page. You can drop me a comment there. You send me a Twitter message. I don't know if you can do that. But anyway, you get the idea. So God bless everyone. Happy trading, and we will see you soon. Bye now.